Really, this is that's what most of England, besides Darrell, it was always useful, and other people that pitch. By the way, thanks Tim, thanks to the other people that did the presentation. But really, I'm very excited about this because that's what we do every year about our panels, and I have bring all the best. You know, there's this man that doesn't need to be introduced. You know, we'll have him introduce himself. Michael is doing a lot of. David says that Michael. Michael is not here to. David Silva is very well known. So, and other would have the Rika, and then some lawyers. So, but my point is that I mean these are the lawyers that probably have to pick at least altogether about $10,000 an hour or something like that. 10 grand. So we have the expertise. They all about. Regulations and all those other things of the SEC. So, and we're gonna hand it to you guys, and go ahead, start with you, David, and see who did you sue lastly? Who did you sue? He sues everybody, by the way. All these ICOs, he sues them. He's very famous for that. I'm not kidding.
Oh, I appreciate that, but my name is David Silver. I do not bill hourly, so I actually take down the average. I haven't billed hourly since 2010. I started representing, I got into crypto by accident. In 2014, I was traveling on a philanthropy mission, and someone actually we were at a bar, and someone took everyone's cell phone and gave them Bitcoin. At the time, I was like, well, this guy's going to jail. I mean, who gives out Bitcoin, and what is Bitcoin? And when the peak happened and it hit $20,000 and those 5 Bitcoin were worth $160,000, I decided, wow, this shit might be real. And I'm not giving it back to the government if they come asking for it. But it did lead me at that point to start looking into people who were investing in the space. And I was simply a financial securities fraud lawyer. And I started having people come to me saying, well, my accounts were hacked and all of my Bitcoin's missing. And I started suing on my first lawsuits. I sued the first exchange, the first cryptocurrency exchange in the US. The first lawsuit was against the exchange called Cryptsy. What got national attention last week was we settled with Coinbase, a derivative of that class action, a couple of weeks ago for about $1 million. The clients wanted their crypto back. Unfortunately, the laws, and the panel is going to discuss the state of the laws. Most people on this panel are more regulatory than I am. I'm just a simple, strip mall lawyer who represents people who lost money. They're innocent investors, and they had no idea they were investing in an unregulated space and that bad actors existed. Currently, I am lead attorney for class actions against, see if I can do this, OneCoin, Nano, Monkey Capital. I am not the lead lawyer in Tezos, so those of you who want to know why the Tezos case isn't moving that quickly, the average investor in Tezos invested at 50 cents. I haven't looked recently, but I think it's like $3.50 right now. So no investors want to give back their tokens since they're up 5x in value. All my clients, their money's at zero and they want their investments back. So when people lose their money in crypto, they tend to come to me. The biggest lawsuits I'm actually doing right now are related to SIM swapping. If you don't know what SIM swapping is and you're in this room, you are going to be a target and victim of SIM swapping one day. You should learn. I myself have been SIM swapped. I have over 40 lawsuits against AT&T. In the middle of my 5th lawsuit, while arguing in front of a judge, my cell phone went dead, and I looked at the general counsel of AT&T and say, I literally just got SIM swapped this very moment. And the AT&T lawyers looked at me and they said, you can't say that to the judge. I said, I'm not lying. I'm not making this up. And I literally got SIM swapped that day. SIM swapping is probably the biggest problem in crypto right now. So I'm sure we'll get into it a little bit later on, but if you have been SIM swapped, feel free to talk to me. We have lawsuits against AT&T, Verizon, T-Mobile, and Sprint. I'll move it down, or I'll let Bob talk for a second, introduce himself.
Sure, thanks. Sorry for arriving a bit late. I was just out in the hallway. My name's Bob Cornish. I'm an attorney with Anderson Kill, New York-based law firm. I work in the firm's Washington, D.C. office. I am co-chair of the firm's Fintech and blockchain group. A lot of my work in the area stems from my experience serving as a chief compliance officer for an investment management firm, a family office, and a broker-dealer. I'm a former Series 24 registrant. Had enough of supervising brokers, so returned to defending them and dealing with the regulators. I've been admitted in the state of Wyoming to practice for over 15 years. I am a member of the Wyoming Blockchain Coalition, and I helped draft certain provisions of the Wyoming blockchain banking laws, including the UCC provisions. The recently passed rules last week on municipal debt and captive insurers. I had a hand in drafting some of that and working with the legislature. So anybody who's interested in exploring the Wyoming infrastructure that is out there and the solutions that are trying to be undertaken at the state level from a regulatory standpoint, happy to discuss those with anybody here, and just really happy to be on this panel with such good people.
Why don't we, before we, so we don't use up all our time in talking about ourselves. Why don't we, while we introduce ourselves, either give some of our thoughts either on Hester Pierce's suggestion, what we think of it, where it's going, or the recent Telegram case, so we can start getting into some argument in the middle here. And Bob, feel free to chime in so that.
Yeah, sorry about that. I followed David's lead, so we're obviously going to be verbose. Yeah, the Hester Pierce thing is very interesting. I mean, the idea of a 3-year moratorium, or I guess safe harbor period for issuers of tokens, quite a conundrum that this has brought to the attention of regulators, especially those in Washington. The idea of providing a safe harbor for people, I think, who are perceived to be somewhat edgy in a regulatory sense has a lot of hair on it, I think. How you deal with that from a regulatory standpoint in terms of actually enforcing or implementing a stay like this in light of having a very zealous enforcement group in Washington that, as we know from the Enigma case that went down a couple days ago, there is a pretty good infrastructure right now that the enforcement folks in Washington have for dealing with people who have skirted the edges of violating Reg D offerings. But what purpose does that really serve the capital markets, I think, is really the question that it comes down to. I mean, we all want to preserve the ability for real people to have real access to the capital markets. And it's not certainly coming from Wall Street. It may be coming more so from the digital area. How do we deal with that? And how do we create a market environment that protects investors and also fosters innovation? I think Hester is probably on the right track. I think there's a lot that goes into her thinking that may parallel what we have to the north of us in Canada with the venture exchange up in Toronto. You have to do a deal up there. You do an issuance. You have an event that actually triggers you to get onto an exchange. I think that's more along the lines of her thinking, that we probably need something more junior with a little, more of a sandbox, so to speak, for the digital and blockchain world to explore the capital markets.
All right. My name is Rika Khurdayan. My intro will be super brief, and in any case, it's not as nearly as fascinating as David's. So, I'm a lawyer in the digital securities, digital asset space. Our firm is based here in New York, Dillendorf, Khurdayan. I do a lot of transactional work, structuring, regulatory compliance. And that's interesting, Stephen, that you brought up Hester Pierce's proposal and Telegram together, because I think those two go hand in hand. It's hard to really look at Hester Pierce's proposal without just the situation with Telegram popping up in your mind. The first thing that comes to mind when I think about her proposal and what she's trying to address. The way I look at it currently, there are two types of projects in this space, right? There are ones that are issuing digital securities, meaning something similar to a traditional security, just wrapped up in the digital form and blockchain enabled, and those projects are very easy, very straightforward from legal and regulatory perspective. There is very clear regulatory framework on how do you issue those assets, what happens next. You comply with holding periods, and they potentially could be listed in alternative trading systems. That's all clear and fine. And now there are other types of projects, the projects that are truly building decentralized systems and protocols, that are building networks with tokens that are meant to be used on the network. They would love to comply with security regulations, and many of them do. They actually go through Reg D sales, right? But the question then arises, after you raise capital with a token and you've done a private placement through Reg D, how can this token later be used as means of payment on the platform? How can you use this token to compensate developers, miners? At what point this token, stops carrying the features of a traditional security? Because then if we apply security regulations for every single transaction on the platform and every single transfer, it would really be impossible to operate the network. And those are the most fascinating projects, I think, in our space. And that's exactly what Hester Pierce is trying to address with her proposal. She's saying there are projects that can never develop sufficiently and in any meaningful way if we continue applying security regulations to them. And this is what's happening, interesting, because I was just at the Telegram hearing yesterday downtown, and this is sort of the regulatory limbo that Telegram and a lot of other projects are finding themselves in. On one hand, they raised capital, they complied with security regulations, they did an exempt offering, right, of tokens. On another hand, in order to build out their network, bring users to the network, they need to be using the same tokens, and now they can't quite do it because the regulators treat it as securities. So very interesting proposal, safe harbor. I think from practical perspective, she did spend some time discussing the disclosures that they would want to see in the offering documents, and that went slightly beyond what we've seen in practice in token sale offering documents. She really spent some time, on saying what kind of information do we want to see on team compensation, rights to receive tokens in the future, any big chunks of tokens being sold by the team. And another interesting thing is about ongoing disclosure requirements. So she wants the projects that are raising funds via token and actually building out decentralized networks to continue provide certain very specific information to purchasers and investors within the 3 years that they're building out the network. Yeah.
So, David, I want you to know I still bill by the hour, but whether my clients actually pay that is a different story. I'm Joel Telpner. I am a partner at Sullivan & Worcester and chair our fintech and blockchain practice. We've got a large diversified practice working with a lot of startups, with established players, with exchanges, and with folks around the world. And one of the things that we've been doing a lot of lately is working on central bank digital currencies. And in particular, we're in the process now of working with the Marshall Islands that will be the first country in the world that will issue a new sovereign currency solely in digital form that will not exist in paper or coin at all. The challenge and problem we've had in the space so far is, I think, confusion and misunderstanding both among regulators in the marketplace as to what we're talking about. And so let me just say first that what we're not talking about are traditional equity securities or share capital, whether it is in traditional or digital form. What we're talking about is this concept of a so-called security, because it falls in this miscellaneous definition of investment contract that anybody that's gone to these conferences over the last few years has heard about until they're, sick to death. And so, the SEC is said in part, and I'm not sure I agree with it, but that their hands are tied and they have to apply the so-called Howey test to these tokens, and to the extent they look like an investment contract, they're therefore security and have to be regulated on the same basis. But that begs an important question, which is that really the right starting point? And I think what Hester is really trying to do is to pinpoint the fact that we're not really talking about securities. And instead, what we're really talking about is software. Software that can have all types of different attributes, features, functions and uses that can vary depending on who is holding them, why they're holding them, when they bought them, and can change over time. And therefore, to try to take something that people intend to use, to spend, as to serve as a means to provide identity, to serve as a way to get access to something, to take that thing, whatever we want to call that thing, and treat it the same as a security, which is historically a passive investment, simply makes no sense. And I think what she is trying to do is to recognize the fact that simply because we're selling that thing, and that thing is raising money for a company, doesn't automatically mean it should be treated as a capital raise the way we treat traditional securities transactions. We sell things all the time in the world that bring in money to companies. Companies sell software, they sell licenses, they sell all kinds of products. They sell them sometimes before they've even built a product, like Tesla that sells the right to buy their car before the car is actually manufactured. We sell all kinds of things that bring in money to a company that isn't treated as a capital raise under security laws. The challenge or complicating thing here from a regulatory standpoint that has pushed a lot of regulators back into the securities world is that the thing that we often sell isn't typically traded on a secondary basis. But the way that this blockchain technology works in many cases is that the users of an ecosystem, the people that want to get involved in the ecosystem, people that want to buy the goods or products, need to get their hands on that software, on that thing. And the way they do that is by going out into the market and buying it from somebody else that doesn't need to use it at the particular time. And so she fundamentally is recognizing that simply because we're using and selling something to raise money doesn't automatically mean it should be treated as security. Now, to her fairness, she said, as Rika, you talked about, that at the same time, fundamental principles of fraud still apply. We're not going to, if we decide to treat these tokens as something other than security, it doesn't mean that people go out and do whatever the hell they want. So she said the biggest challenge that security laws do try to address is an asymmetry of information. So even though in her proposal she's not treating these tokens as securities, she said there's a fundamental policy consideration to apply disclosure requirements in a comparable fashion. So if somebody is committing fraud because they're not telling you the truth, or if they say they're going to do X and then go out and do Y, people should have recourse against that developer, that token issuer. But what she went on to say was, as long as we can provide a robust disclosure or information sharing process, then let's recognize that, again, what is being sold to raise money is not a passive equity investment. It is something completely new that we've never had to regulate before. And therefore, let's give credence to the fact that if people say that the reason that they're creating and selling these tokens is to create a network, to create a business, to create a platform, and that it will only work if you can get that token into the hands of the potential users, then let's give them a chance to prove that out. And she said 3 years is a reasonable period of time for somebody to demonstrate that they've got a functional business or a decentralized business. And if they can't get there after 3 years, then you know what? Then maybe they should not have treated that token as something other than a security to begin with. But let's give the marketplace, let's give inventors, let's give developers the benefit of the doubt and recognize that this technology is not a traditional passive equity security, and we have to rethink the way we regulate this new thing in the world. And I think that's moving us in the right direction.
Thank you. And I'm Stephen Rutenberg. I'm with the Fintech group at Polsinelli, where we're also represent clients on the broad space of this field. We've started our Bit blog, which is getting some more attention. And particularly one of the things that interests me about this field is, let's assume technology, things become, as Dara was talking about earlier, things become more technologically automatic and advanced. Do we trust technology over people? Where is our trust going to be, and where are our protections going to be in a more automated world? I mean, will consumers be better off deciding themselves on purchasing small pieces of, whether it's rights to a potential telegrams thing or rights to a piece of somebody's car? Will that be better off? And or we seem to think that a decentralized world will be better off, but will that be the case? And for anyone who's not deeply involved in the Telegram in Hester Pierce and in Telegram, just by way of a tiny bit of background, Hester Pierce is one of the SEC commissioners. I don't believe an SEC commissioner on their own can make law or really has that much authority, who has always been kind of favorable to the crypto industry, and I think did a huge favor to both making this panel more interesting and to everyone in this space by proposing this kind of rule to really take these things out of the securities laws. And I think this will end up being a question to David in the end. I mean, I want to take kind of what you said, Joel, a step further. It's really not a question of whether it's software. I mean, that is true. But the real question is whether it's fraud. And we have lots of laws protecting against fraud. And the real thing that they're saying here is, let's not look at these as being securities. Let's look at this as a potentially fraudulently sold product. And generally not on the federal level, but I believe in New York, if you sign up for a gym, you have a month to quit or a certain amount of time to quit your gym, because the regulators know that there are certain products that are sold that customers are often defrauded by. And to me, the right of purchasing a coin that may be used, I had a client call me early in the Telegram process and saying, should I buy these Telegram tokens? I'm worried about the form that it's being in. I'm used to buying options. I said, the documents look fine. Personally, I'm highly skeptical that there's value behind this. But the real question is, I think it's a question for David, is if people are buying in billions of dollars of a token that may be, or some asset that may become a token further on, may have a right to a network, they should have a right to buy that and right to lose their money. If we take one of David's tools out, that he can no longer rely on the securities laws or rely on most of the securities laws to protect investors in that situation, how much more difficult will that be to protect investors or purchasers of these assets if we're not relying on our securities laws? Another way of thinking it is, our anti-fraud laws robust enough that we can protect people from buying these products without having it fall under the securities laws?
So I'm happy to jump back in. As you guys are going to notice, one is different than the others on this stage. So it's really funny. I've been called a crypto skeptic. I've been said I don't like the technology, and it's all horseshit. I love it. I think this is great. I think it's the wave of the future. We're looking at, right now, a horse and buggy to the combustible engine. I mean, crypto, and whether it's, and people ask me all the time, is it Bitcoin? Is it Ethereum? Is it, this Nano? Is it something else? I can't tell you which crypto is going to be, but the technology itself is going to change the way we do business. And basically, it's an evolution of the credit card. Most of us don't carry cash anymore. We use credit cards. And that's just a tracking mechanism. The tracking mechanism is getting better. But the problem is with what Hester Pierce said in the 3 years. First of all, I don't really care what she says. She's a commissioner. She's entitled to her opinions. I disagree with her opinions. You don't deserve 3 years to have a playground. The federal government is going to announce their own crypto regulations. It's come out in the last couple of weeks, so I think we're all going to have a whole new slew of things to talk about. But we're going to talk about Telegram for a second, because the court in Telegram came out and said they don't care about labels. It's the economic realities that matter. And for most people who invested in ICO between 2016 and 2019, you lost all of your money. There was a problem in the ecosystem, and fraud permeated the ecosystem. But there were two major law firms in the United States, who I will not name, who basically did most of what the quote-unquote legitimate ICOs went through. They charged $250,000 to $500,000 to do your ICO. And your ICO came with pages and pages and pages, 50 pages of disclosures. And I said to everyone, let me ask you this. Do you know who you're investing with? And they said, yes, I'm investing with Michael Schmidt. I'm making up that name. There is no Michael Schmidt. I'm looking in the camera. There is no Michael Schmidt. I don't know a Michael Schmidt. Where does Michael Schmidt live? He lives in New York City. Great. I'm looking at this paperwork. Do you realize the company you're investing in is in made-up country in the middle of nowhere that if I gave you a map, you can't point to? He goes, no, it's in Malta. I said, great, point to Malta on a map. He couldn't point to Malta on a map. So, at the end of the day, if you're doing business and you're looking at people, are you saying, are the fraud rules strong enough? Well, the problem is, what Hester Pierce is talking about is disclosures. Disclosures are good as long as they're enforceable against the person that you're investing with. everyone in this room, and Michael Turpin just gave a great talk. I love Michael. Michael and I do a lot of these programs together, but Michael's talking about creating businesses and creating entities in different places and what's best for you, the company. And what we're talking about on this stage, and I think Joel was talking about how the central bank in one of the foreign countries is going to do the first stable bank coins. I think that's the wave of the future. But the problem is we're in a global world where I can buy something I can take out my phone right now, buy something with a company that claims to be doing business in Switzerland, and when all of a sudden my money goes missing, I want to sue that person in New York. That person says, well, no, read the disclosures you just signed and the terms of the deal we did. Those terms say you have to sue me in Switzerland, and Swiss law applies. Well, let me tell you, that's getting really complicated. Another case that came out today is, where does the transaction occur? Well, if we use Bitcoin, for instance, where's the node? Suddenly now I have jurisdiction, and I can sue someone here or there, different places. One of the largest mining fields just opened up in Texas. So the answer is, and I used to say this all the time, I started doing these lectures in about 2015, 2016, don't steal money. If you don't steal money, all of these things make it really easy. So we're talking about what is the fundamental basis of what the law should be. The law needs to evolve. I don't believe crypto should be excluded and is a special, platform. Laws will apply to crypto. Anyone who thinks laws aren't going to apply to crypto, I think you're smoking a peace pipe that, you need to have your head evaluated.
But I don't think anybody up here is saying that laws don't apply. I think the only question is whether security law regime is the right regime to apply. And I think that a lot of people, including regulators, are starting to recognize that while we don't want fraud, we want sound market practices. We need to have this market move forward in the right way, not the wrong way, but it may not be taking traditional security laws, especially in the United States, that have evolved from the 1930s, and applying them to a technology that wasn't even contemplated at the time our security laws were written. So it's got to be a different way to...
So you would agree with me by saying this? Clarity is what we're looking for.
It's more than just clarity. It's what we need to figure out, and just to point out that it's the point that the securities. If you want a product and you want something to operate as a product, the security you don't want it to be a security, because a security is something for investment purposes. You can't take your broker dealer to Starbucks with you. I mean, if you want something to eventually
you can't, you'll have to pay.
Eventually, yes. You won't be able to use it to pay at Starbucks. You'll still be paying with your credit card. If you want something, if you believe in this ecosystem model or a product model, I mean, there are plenty of things that will be, in theory, security tokens if people start putting securities on a blockchain, and that's a whole separate world which will or may not develop. If it develops, it will be great. I don't think any of us here on this panel are really talking about there now. We're back to 2 years ago of your product utility token, and the question is there a space for those to exist outside of the securities laws? And I think the answer is the other way around. If there's a space for those to exist, they can't exist under the securities laws.
See,
there's no space for them to exist. But if they are going to exist, they're not going to exist as a security. There are security tokens which they'll exist. Those will always be securities.
But wait, I think very important also whenever we're discussing regulatory framework for blockchain tokens, let's call it this way. It's very important not to conflate fraud cases with enforcement actions for unregistered sale of securities where there were absolutely no instances of fraud and people still got in trouble, right? So fraud is fraud. No one is arguing, that there will be a regulatory framework appropriate to enable potential fraud cases.
Though the SEC securities laws make fraud cases much easier. I mean, this 10b-5, there's other parts of the securities law. And my original question to David, but I'll talk before we get back to him, but is whether or not without having the securities law fraud protections, there's still a strong enough fraud rules to get the bad guys and let the other people pass through.
This is a fundamental flaw in a lot of what we're talking about, I think. One of the things that constantly irks me about the blockchain and digital asset world is the fact that we already have a field of law that actually applies to a lot of this stuff. It's called the commodities laws, the Commodities Exchange Act. We have a whole scheme of regulations and laws that apply to things that people buy and sell. Well, it's like cotton, soybeans, cattle, coins. There's already rulings and regulations out there about how digital assets and crypto apply in the commodities world. And I think we have a very flexible framework to adapt through rulemaking or through some creative lawyering that the commodities laws really provide, I think, the best safety net, I think, to protect investors and to facilitate innovation.
You're right, because the commodity laws say that cash sales of commodities are exempt from regulation except for fraud and market manipulation. So they hit at the heart of what we're talking about to make sure that consumers are not subject to fraud, but otherwise they leave the market alone. Now, the unfortunate part, though, of what you're saying, which I agree with, is that to a large extent the CFTC has, in effect, delegated or given up the market space to the SEC. They have basically acknowledged the at least existing view or attitude of the SEC as expressed by the chairman of the SEC that most, if not all, tokens that have been sold to date are securities, and rather than the CFTC saying, no, wait a minute, we think that they should be treated as commodities, they've gone along with that. So
I don't know if you saw the letter.
it may be too late for that to happen, but
If you saw the letter yesterday from the CFTC, I mean, there was the CFTC in this Telegram case where they've pre-sold these tokens, and the SEC is trying to stop that. The SEC reached out to the CFTC. The judge actually, the court reached out to the CFTC, which regulates
Because they thought it was
commodities and regulates Bitcoin. If you want to think about the CFTC, very simple. It regulates transactions in it, but not the individual sale. Meaning, the guy selling bananas on the corner, it does not have to have a license to sell those bananas. But if you want to do something bigger in the selling of bananas, you do need to be registered. But the SEC reached out to the CFTC. The court reached out to the CFTC and said, "What do you think here?" And my reading of the letter that I think just came out yesterday was basically the CFTC telling the SEC, "We're giving you first dibs."
Yep, that's exactly it.
If we believe these are all commodities, but if you think this is a security, we'll let you take it. That we're not gonna try to carve out jurisdiction. We'll let you take. I mean,
That's exactly what happened.
some other papers said that the CFTC letter didn't say anything, and I'm like, no, I think this letter is actually saying a very strong statement that we're going to be kind of subservient to you in this space. We will regulate when you don't believe it's a security.
And I think the reason for that is simple-fold. They don't have as big a budget as the SEC.
Yeah.
It's a budget issue. And, and this goes back to economic realities. The CFTC, trust me, if they thought they could regulate this and they thought they would get the funding for it, they'd be the first ones. It's, government 101. Why spend $1 when you can spend $2? If the CFTC thought they could get bigger budgets to enforce this, its enforcement is really hard. I mean, the CFTC is in
I don't know about that. The current chairman of the CFTC, which makes me feel like old and unaccomplished in some ways, is one of my law school classmates, and he is one of the old school libertarians, and he's very much, if government doesn't have to get involved, government doesn't need to get involved.
And what's the former CFTC chairman doing right now?
I don't know, but the current one is very much a libertarian in the true sense, and I don't think he does not want to see more government regulation than is necessary.
So, but my point being is that at the end of the day, the CFTC is involved in several of my cases. I actually give them credit. They've jumped in. There's an individual named David Saffron who's being sued by the CFTC in Nevada. There are a lot of Nevada corporations who did what can only be described as stealing people's money through crypto and not paying it back. And the CFTC's jumped into several of those cases. There's also another case out in New York where they were trading on Discord. I apologize, I'm blanking on the name for a moment. In that case, the CFTC jumped into. So the CFTC is jumping into a lot of the fraud and manipulation cases that the SEC has stayed out of, and they're doing it on a less of a global scale. But I do agree. I mean, is it possible the CFTC? Sure, someone's going to eventually grab this by the neck and do it. I just think that we're going to see the federal government come out. Mnuchin and Trump are going to have their say in this, and we're going to see how this plays out in the courts. I mean, whether or not The Tezos case goes one way. There's a case in the Central District of Florida that's moving fairly quickly called Centra, where damages are being established for people who invested in ICOs. Are you entitled to rescission when the ICO turns out to be fraudulent and manipulation? Are you entitled just to rescission? Are you entitled to your crypto back? Are you entitled to damages that are the high point of the value of the crypto from the time the company held it? The Coinbase settlement, one of the biggest complaints that we got, and these were legitimate complaints, that happened in 2015. The court ordered the value of the Bitcoin to be $500, and we didn't get back crypto. We got back US dollars. So they preferred their crypto, their Bitcoin back. But the laws need to be established, and we're not there yet. I mean, and this is where I was going back to the clarity. I am a huge advocate of clarity. I don't care, and I am not advocating one way or the other what the law should be. I want to know what the law is, and I need people to clarify that, because what I don't believe is large law firms representing large companies who are screwing over investors get to dictate what the law is. I read some of these terms of service, and they are egregious, unconscionable. They have been thrown out by several courts in several of my cases. You know, you do business with some of these people, you sign it up because you believe in what you're doing. When things go bad, they're like, oops, sorry, no, we have no responsibility. In fact, you indemnified us if you sued us. That's ridiculous. So all I want is to know what the law is today, and I'm going to keep suing people who take advantage of investors.
But we're somehow circling back to fraud cases again. But what do we do with non-fraudulent projects that are trying to build out protocols and networks, you know? What is the...
Again, I mean, I'm gonna let Bob's much more articulate and is on the forefront of the regulatory. Joel and you guys are all on the forefront. I have to interpret the law as what it is today. I'm not here to create the law. And I said, I'm not advocating one way or the other. It's gonna change. I think everyone up here agrees that it's gonna change, and what it's gonna be in the future is hard to tell. What is it right now is open for discussion.
I mean, do
Well,
we
let's
have
let, I mean, let's
consensus
face
here?
let's face it. I mean, a lot of your point on otherwise legal protocols. I mean, I think it all comes down to the basic issues of inefficiency at the SEC, frankly, on the Reg A Plus thing. I mean, the whole issue of people wanting to go public and being able to do so in some manner was held up in such a manner for numbers of years. I mean, I think if you read the statistics, there were over, 3,000 Reg A filings, over 186 of them have actually been approved, and there's 2 or 3 that are actually digital or crypto. I mean, there aren't that many.
But why do I, as a project, need to go through Reg A Plus offering? Why can't I offer it to accredited investors, to venture funds, and later build out the network? Why can't I be using just like very simple Reg D exemptions that are super fast, super cheap? Because Reg A Plus, whether it's tokenized or not, it's quite expensive, and
Because-
it takes
I agree. That's
answer
putting
that,
us
let me
back in the
rephrase.
securities realm
Yeah.
again, and I don't think we need to be. But, you know, look, David, there were some of the issues that you raised, which I think over time have to be addressed in the marketplace, whether or not we're talking about being inside or outside of security laws regimes. For example, we're in this new world where we don't have necessarily an existing corporate entity. So when a piece of software is created and sold, the concept of there being a corporate entity that is located in a specific jurisdiction that is contractually responsible doesn't exist potentially the way we did in the past. And so whether or not we're applying security laws, we do have to think through, going forward, a number of these fundamental issues. For example, we think it's prudent as a marketplace and on a global basis to require there to actually be some type of legal entity in some jurisdiction that ultimately has contractual liability for what is being created and sold? Or are we comfortable, again, regardless of whether we're in the security laws regime or not, acknowledging the fact that a token or software can exist, like in the case of Bitcoin, where there's nobody behind it? So we have to think about a number of legal and regulatory issues and marketplace protection issues. But again, I would urge us to do that without immediately putting it in either the securities bucket or the non-securities bucket, but to think about it in the realities of what this new technology is all about.
And to kind of rephrase what Bob, or really to ask Bob, and that, I mean, if we have a choice of we have these tokens that are network tokens. Let's leave out for a second that we're selling them to accredited investors. We want something sold to the public for a second. We want our token to be available and access to the public. I see there's two possible ways of doing that. One is some mini IPO, which is basically Reg A+, of getting it out to the public through a securities offering to the public, and let's say ask the SEC to make this Reg A+ work. Or do we say, no, this is just not supposed to be in Reg A+, this is not supposed to be in the securities laws, this is just a product, should be regulated by the CFTC under fraud. And what do you think would be a better outcome for the world? Because
I have I guess a different view, perhaps, because I've worked in the institutional world. I don't think the institutions of the world who are investing in these ventures really need the protections of the securities laws. I mean, these are the folks that have the capacity to do the due diligence.
But right now we're talking for the hypothetical out here is to the public.
Is to the public.
We want something that the public gets to get network adoption. Should it be Reg A+, or should it be just outside of the securities laws?
I think it should be outside of the securities laws, but I think it ought to be regulated in some manner by some federal agency or through self-regulation, which is something we haven't talked about. One of the things that the securities laws and the commodities laws provide is that industry participants can create self-regulatory organizations to actually prescribe the rules through which people participate in the markets. And for whether you're a fan of it or not, people know how to, people know the parameters of working at a FINRA broker-dealer. They know what you can do or you can't do if you're sitting at a desk trading soybean futures in Chicago. There's rules and procedures that protect the public from a number of things, and for the most part, they work. There are arguments, of course, that the fox can be tending to the henhouse. I'm sure you've used that once or twice, David. But who better to create the market rules than the market themselves? At least at this point in the equation, because really, unless the market coalesces around set procedures and set rules and gets to the point where there is regularity in the way that capital is raised, then people are at risk. But if the industry wants to grow, it essentially has to do this, I think, to gain credibility with just not the institutional market, but the public as well.
And I actually completely agree with what he just said. Bob and I are on actually the same page on this. FINRA is a perfect example for a self-regulating system that works, but you have to participate in that self-regulating system, finance that self-regulating system, and more importantly, we have to stop this nonsense of these companies pretending to be in foreign jurisdictions when they're really not. So there is the ability to jump. We have a structure in place here that actually works within our financial institutions, with your financial advisors are held accountable. I would like to believe that crypto can go in that direction. That is a long way off if that would ever happen. I am more likely to be the starting point guard for the New York Knicks next year.
And I think
Just as an aside, by the way, self-regulatory organizations include exchanges, all right? That's the New York Stock Exchange, NASDAQ, all kinds of Cincinnati Stock Exchange. All these exchanges that you hear about that are handling crypto and digital, those are very well good candidates, frankly, if they wanted to undertake becoming an SRO, to put their own rules in place for listing, for market conduct, and all of those sorts of things, they should do it.
And I think David's. This is going to make me sound a tiny bit like David for a second. I think the crypto industry has done a horrendous job. At least a couple of years ago, in getting off to a really bad start in terms of regulating itself. From top law firms just really letting things go by that really wouldn't pass their own smell test. One of the other big cases out there is Kik, and Kik did both a SAFT, which is something we could have a whole panel talking about, to accredited investors, and then did a public sale also. And what I found deeply offensive about Kik is that the accredited investors, the rich guys, got more information than the public did. because the public got nothing. So what you're saying is instead of democratizing the market, you're making it an easier way to screw over the small investors. I mean, let's not be so sure that Wall Street is doing such a bad job and that a bunch of programmers and us are going to do a better job. I mean, because the Wall Street model, look at WeWork. I mean, when things get to the public, sometimes the crap comes out. And I think the crypto industry is doing a better job, but a lot of the blame has to do with the industry. I mean, looking for jurisdictions with no regulations. I mean, I had clients who come to me and I said, well, why don't you do a Reg D offering, like Rika was saying? They're like, well, sophisticated investors need documents. So I'm like, I'm not taking part in your game of trying to figure out who we can screw over here.
So we agree, though, that there's nothing wrong with applying consumer protection concepts to these sales without necessarily treating them as securities. We have the FTC. That is one of the federal agencies that helps with consumer fraud and consumer protection. So there are a lot of other ways we can go to protect the market, protect smaller purchasers of tokens in the market without, again, embracing and imposing the entire security laws regime on top of everything.
I think we saw a question.
Yeah, it's just interesting because no matter who regulates it, you still have to address, I think, what the main, key issue is, and that there's a big distinction between fraud and failure. And I think that's really an issue that never gets addressed, but it's really the most important question. And even the example that you gave about the gym. So they give a month for people to cancel their gym membership. Well, maybe the gym didn't do anything fraudulent. Maybe the person was just, a lazy, doesn't want to work out.
Right. And so that goes back to, I think, two things, which, regardless of what regime you're in, information that's provided to a purchaser at the time of purchase. And there's nothing wrong with having regulations that demand appropriate disclosure of information. Second, we certainly, regardless of what regulatory regime we're in, is insist on certain contract standards and contract provisions that are designed to protect purchasers. And those are the types of things that I think, hopefully over time, the market itself will be demanding more and more of, so that whether or not these are imposed from the top down, I would expect from the bottom up we're going to start to see these standards develop, because people that have bought tokens are tired of having their money go away for whatever reason. And I think as this market matures, we'll see those types of best practices coming online together with regulatory pushes.
I mean, one of the core of U.S., more than securities laws, but U.S. law, and this is true to other areas of the world, though I think somewhat less, is there are consumers that need to be protected. I mean, call it the nanny state, call it whatever you want. I mean, we have a concept out there that your retail investors, your aunts, your grandmothers need to be protected from fraud, as well as from overly pushing manipulation, as well as even from overconcentration. I mean, one thought I had to add to Hester Pierce's idea was that to limit each individual retail purchaser to, let's say, $1,000. I mean, whether or not that was similar to the crowdfunding platform where each person's limited to do that. Because you do, look, part of the thing about the gym is you're being a failure. Part of it is you're over-pushing salespeople. And the question is, I think this is one of the questions we have to think about as a society. Do we suddenly not feel that these people need protection? Do we feel that we can handle that without that? Is software going to deal with that somehow?
I'll tell you the number one call I get that deals with that is I invested in ICO. They claim to no longer be building the product. 90% of the money went to marketing. That's not what I invested in. I didn't invest to marketing for being 90% of the investment was to build the network, do this, that, and that. I got a lot of lawsuits going on in New York right now that deal with that issue, and they're outside the securities laws. That's just so. And to circle back to where we began, is Hester Pierce's, recommendation what we should be talking about? The answer is no. The answer is we need something better than that, but we also need the market participants to want to participate. And the problem is the culture in crypto at the moment does not want to participate with U.S. laws. They want to move it outside, and they want to get away from the laws because they don't like the laws as they exist today. That doesn't mean they won't come back and they won't participate and that there aren't people trying to legitimately participate. But the problem is they don't want to participate as they're written now, and this goes back to what Joel was saying about Howie. why would the case about I'm from Florida. Why would the case from Florida citrus in the 1940s apply to tokens? It's ridiculous. But, there's a lot of ridiculous things, so it's the marketplace will eventually dictate because
I don't know that it's so. I don't know that the Howey test is so ridiculous because the markets haven't changed that much in some ways since the 40s, and actually the Howey test, which was where we get securities law from, which was in Orange Grove, which actually fits in very similarly to the question between where is something an investment contract or not, and where is the borderline between a commodity and a security.
Except the oranges weren't programmable.
Is your partner Jason Nagy here? Jason, you in the room? He's going to be speaking this afternoon. The last time, I think it was 2 years ago, I spoke on this panel with one of his partners. I get a great quote for one of my lawsuits from one of his partners. I'm going to quote him on that in one of my next lawsuits, saying, I think, even they believe Howey applies. Because I actually am living and dying by that, because this goes back to what I was originally saying. I only care what the law is today. The law is changing. I'm not advocating one way or the other. Someone else had a question.
Yeah, I'm curious from all your guys' perspective, kind of when it does go to Mr. Pierce, safe harbor thing that she's proposed is, to what extent are they doing this because they're just behind the eight ball and the internet's moving way faster than bureaucracy is really able to move, and I can read the ad in the bit banks right now and do something that's they're saying is illegal in the U.S. in the same way the tokens sell, where they're saying we're not available in the U.S. and there's nothing you can do about it.
Well,
Well,
one second. They still. I want to first take something. We can get the other. Take some exemption that's not really the case that the markets are moving so fast. On one hand, we say we can't do anything without the U.S., and on the other hand, we're saying people are fleeing from the U.S. This is a tiny market. The fact that the SEC is giving it this much attention just shows that this is a market of interest to people. This is a thing that people could believe could be revolutionary in the future. The government still wants to protect U.S. investors.
But it
yes,
may be
you can buy
tiny
it.
because of the regulatory regime we're stuck with right now.
That could be. We'll never know.
There's a pragmatic way to look at what's going on, which is that, and David, as you said, maybe we shouldn't be talking about Hester's proposal, but one of the reasons why it is relevant is that it creates the possibility, for now, of a regulatory solution as opposed to waiting for a statutory solution that will require new legislation. So to the extent, and again, we have to look at her proposal in light of the reality that the other commissioners may not be on board, and so this may be dead in the water, but at least she's out there demonstrating a way to take our existing regulatory regime and represent the fact that it's flexible enough to address this new technology without having to go to Congress and asking for new legislation. And I think that is the importance of what she's doing.
Yeah, there's certainly.
I'll jump in. I actually don't see projects avoiding U.S. as a jurisdiction. I just, in my practice in the blockchain space in the past 2-3 years, so there are two types of projects, right? If we're talking about tokenized traditional securities, there are non-U.S. projects that are actually seeking to do their offerings through the U.S. because in terms of digital securities, we have one of the easiest frameworks for doing that compared to the rest of the world. It's much easier to issue digital security in the U.S. via a private placement rather than doing it in Singapore, in Hong Kong, in Switzerland, anywhere else. And then there are projects, again, that are building protocols or network tokens. Even if they start outside of the US and they went through capital raising blocking US purchasers, they will want to access the US market. If you're building a successful product, you cannot ignore US as a market. So they will go full circle. They will raise money outside of the US. And then 1, 2, 3 years later, they're going to come back here anyway. So there is really no way to avoid U.S. market or U.S. regulations.
I think going to your point about regulatory inertia, I think there is no better indicator of that than the fact that the SEC is now inviting people who are considering coming into the United States to raise money to actually have sit-downs with market regulation, to actually explain what their products are before they get going. They are trying to outreach to people, but they do recognize the fact that they are, like you said, behind the eight ball because, frankly, as we've discussed here, there are limited regulatory resources. And this is such a small slice of the business, of the global markets right now. But, the folks up in enforcement in Washington have determined that this is an area that requires protection of retail investors. We always have to remember what the SEC's objectives are. You know, it's market integrity and the protection of the public. And if there are means by which they can do that without expending more money in hiring people and going after wrongdoers, you know, they're taking a more proactive pre-issuance approach right now to do the best they can. And the one problem that they have, you know, in speaking with SEC staff that I know, is the fact that, let's face it, the UBSs and Morgan Stanleys of the world aren't selling digital securities right now. They aren't selling these things. And, you know, they generally look at these models going through already regulated market entities. And you're really dealing with people going directly to issuers, which is a very different model for these folks to be dealing with.
And I also think we have to keep in mind that, and maybe it's kind of chicken and egg, and maybe we need regulatory relief to prove it, is we haven't proven anywhere that there is billions and billions of dollars in value in network tokens. I mean, XRP, there's billions and billions of out there. It has to be worth something if people are going to use it. I mean, what makes this a little bit different than other markets is it's almost completely unproven that there is a scarcity argument that you will. I mean, you can have network tokens be very useful. For example, luggage carts in airports are really useful, but they're not scarce in terms of having value because you take it and you use it, and then you drop it off. I mean, we will have to prove, and I think one of the reasons we possibly need regulatory relief is to try to prove that this whole business idea that you could have billions and billions of dollars in scarcity, and that these network tokens will be worth something for that reason, and that people will buy it for some reason to be able to use it, and not necessarily give it away or just a quick use. That hasn't been proven yet. I think we always have to keep that in mind, that on both sides of this, that we need to prove that.
As we wrap up, couple last questions.
I just wanted to make a couple of comments. Well, I think that there's a central paradox that is not addressed, which is that there is no new thing under the sun. Either it's an equity, a currency, a derivative of some sort, so therefore it should be regulated as the asset that it represents. The idea of the SEC giving you 3 years to build a network that's supposed to be decentralized is another paradox, because if it's decentralized, who are you going to regulate? And if it's not decentralized, then it's under the control of the company, so it's a force for security. So the idea of this, it makes no sense. If it's decentralized and it is a protocol, it's owned by the people for the people.
Well,
If it's owned for the people by the people, it's a redistribution of value, not like buying tokens for a product.
It could be a product.
For something that a user owns now, which is currently owned by a corporation. And so if the problem is with surveillance capitalism not being regulated, Google, Amazon, Facebook should be regulated because that's the value. The value is the network should be owned by us. That's the purpose of decentralization. So if we understand the purpose of decentralization, why would we identify the asset, regulate the asset under the normal framework, and say, what is new? There is nothing new, it's just changing the owner. So the question is, if you're going to protect the owner of the asset, then what are you protecting them from? It's fraud, which, if it's decentralized, is a fraud by the people of it.
I disagree when we say it's not new. It is new.
It is
Because
new.
it can have multiple attributes and features that at the same time that is different than what we have in the existing world.
Absolutely. So it's the change is from linear to quantum, and that's the thing that we're all dealing with, is that you've got linear assets that are connecting in a quantum capital environment. That's the big shift. So the regulator's going to become a genius because it's going to have to understand all flows because they're all connected.
Well, I'll give a slightly different answer. I agree. I don't think it's all that new. I think most of the laws are already there. They just need to be tweaked a little bit. We tweak laws all the time. But I'm also going to be in the minority in this room. I believe decentralization is a myth. So, and I think the recent, DeFi hacks show that decentralization is a myth.
We got 10 more minutes, so we can get a couple more.
Okay, more questions.
You want to waste your time. Don't charge us.
And just to add, I do think that it is decentralization isn't the important part, but after 3 years, you could be able to show that this is not a security, but this product really, whether it's decentralized or not, after 3 years, you could prove who is that this is a product. The question is, who do you go after 3 years? Is it going to be but there's ways to go around
You
it.
can launder the money for 3 years.
You can use escrow, you can use insurance. I mean, it's an innovative idea for us to think about, which is what we've always wanted. I mean, maybe it's escrowing half, maybe it's an insurance, maybe it's some insurance wrap. I mean,
You can't
that's
buy a Lamborghini if you escrow half your money. I mean, come on.
So maybe that's the way to do it. That you can only buy half the Lamborghini.
This is the economic realities argument, and this is my problem with what a lot of people in the industry, especially the lawyers, said early on, and what the companies, and this is my true beef. The economic realities were people wanted to raise money. They found a new avenue to raise money, and they raised money. That's the economic reality of what happened with the ICO meltdown. And most of these things didn't happen, but we can't ignore the economic realities. But what we have now in the unwinding, and why regulation is so hard, because people don't understand government employee, especially, the limited budget and resources of the government investigators of understanding the complexity of what's going on here, is the problem is, as we're unwinding and seeing the first wave of what happened in crypto, we're seeing all these contradictions of both fact, law, and accomplishment. And until we can resolve that, and I agree with what Stephen said earlier, we're at the beginning. We're a sliver. The fact that we are actually getting this much attention from the government is actually pretty impressive. I'm actually not out there saying, dear God, let the regulators look at this more. We're actually getting some good insight. And the fact that you have such qualified people coming into the space on a daily basis, I think is really good.
Look, it's fun to, poke holes in proposals, right, and criticize proposals. I love doing that as well. But what is the alternative? What is the alternative for projects that are trying to build a decentralized system to raise money for that project?
Well, again, let me be crystal clear. I don't believe if you're raising money, you're truly having a decentralized system, especially with almost every single decentralized system we've seen to date.
You're trying to build one.
Has been controlled by people. And it is being controlled, and there's manipulation that goes on. So give me an example of someone who's wanted to be in the U.S. that raised more than $10 million through an ICO in the U.S. that was applying U.S. law. And the examples are few and far between, and the ones that did it and did it legitimate. And let's use, the one Skadden Arps did was, Skadden Arps did one of the largest ICOs. And what was going on with Telegram, Skadden did Telegram. I truly believe Skadden did Telegram in the end, right?
Or kick, which one?
Skadden is representing Telegram.
Telegram.
I don't know if they did their offering, but
they didn't do it.
And when it came through, it's the fact that legitimate players are coming in and they want to legitimate through institutional money. They're going to find the laws to apply. So I'm all for that. Again, I'm not advocating one way or the other, but the more money that comes into the ecosystem, the more law and regulations are going to apply. The reason I say that Hester Pearson, when she's saying the 3-year thing, no, it's not practical. There's the argument for a sandbox has been made that we should have a sandbox. Europe's trying, to pass some sandbox laws that you should be allowed to play in the sandbox, and we can learn through giving people some get-out-of-jail-free cards by letting them do it in a regulatory sandbox. I'm not actually against these things.
I don't know. I think her approach is practical because the most important thing in it is she made it very clear that fraud and market manipulation are going to be prevented and forbidden regardless. And so it's not, the 3 years is not a path to do nefarious things or to engage in inappropriate or illegal behavior. It's just a 3-year period to recognize that we're dealing with a new type of asset class that hasn't existed before, but at the same time applying traditional standards of fraud and market manipulation.
and disclosure. I mean, its question is how many of the ICOs would have complied and been willing to comply and not looked for another country, because they would have to really provide real information that would be judged by the SEC. I mean, this is not a get out of jail free card. I mean, there is questions about how the end is going to work, but this is not simple. This would give, I think, plenty of ways for David to find ways to sue under the securities laws, even for lack of proper disclosure. So I mean, the original question to David isn't entirely true, because even if these aren't securities, the SEC has left in enough teeth here, which I personally think it's worth a try.
In a way, by the way, it follows the commodities example. Mm-hmm. You're treating, one way to think of her proposal is these are exempt securities the way we have exempt commodities, and purchases and sales are not regulated but for fraud and market manipulation. And so that's an interesting, I think, angle with respect to what she's trying to do.
I don't disagree that there's going to be a different approach. And again, I have routinely called for clarity. And when I say clarity, we need rules. I actually was a huge proponent of Gemini when they ran their Crypto Needs Rules campaign on the buses, on the bus stops. I don't disagree, and I'm completely for what Hester did by putting this out there because it's starting conversations. I don't know what the end road is. Again, I am not, and this is what makes me different. I am not a transactional lawyer. I am not a regulatory lawyer. I simply apply the law as is, and that's where my perspective is. I'm not here to solve the problem. I have to look retroactively. These guys were all looking moving forward. So my point is simply this: we need a regime that simply allows companies to innovate, which is what everyone in this room wants to do. You're early adopters. You want to be able to support companies to innovate the technology. You want to invest in those companies knowing that your investments are secure and they're not being used for illegitimate purposes. Everyone on this panel agrees that there will be no exclusions for illegitimate purposes. So the question is, and by the way, this isn't just limited to crypto. There's illegitimate purposes in Wall Street and it's everywhere. So this is not just limited to crypto. The question is, how do we get companies to want to be in the United States, to innovate in the United States, where institutional investors and regular mom and pop investors are comfortable investing? And that's what we're all looking for.
There's a question over here. This lady should, go ahead, please stand up. And could you kindly repeat her question? So what's the question? Could you repeat?
Oh, sure. The issue with airdrops, I think one of those fun things that you have to do as a lawyer, right? It's airdrops and finder's fees, right? And those are the fun things that we have to apply.
Right, before you say that, I mean, one general rule is that securities laws generally, and most of the rules, protect where the investors are, not where the company is located.
Right.
I mean, that's just a general, gives a detailed explanation of how that fits in. I mean, most securities laws, I mean, if you're based in BVI, you could be totally fine, but what your investors all have to be in BVI. So, but then we can.
If what you sold in the view of the SEC is a security, then you're going to have to deal with U.S. security laws.
Assuming you have U.S. investors.
Assuming, yeah.
Because there is a no action letter out there. I think it's actually pretty old, where somebody was actually trying to give away securities.
Tomahawk.
Yeah, exactly.
Yeah, last year.
Yeah, they were saying they weren't engaged in a distribution. And
Yeah, if you're creating a market for your securities, even if you're giving them out for free, SEC considers it a sale of security.
There is an exemption. I mean, just to fill the whole thing out, there is an exemption if something is sold abroad and only abroad. It's called that's Reg S that you'll hear about, in which at some point it's allowed to flow back into the U.S. as a security, but even that one has to be careful about. But there is an ability for something that's sold abroad to eventually come back to the U.S., but that's...
I'll give you the example of what that gentleman over there asked. When he VPNs and takes your airdropped security token, you're now in the U.S. under U.S. jurisdiction. It's why this whole thing is changing on a daily
I have a
basis.
question from the banker over there, and Ron DeBerry.
Right? I can get on a plane, go somewhere, buy something, I'm subject to where that thing is really created itself. Now, if I VPN into a foreign domain, the fact that I'm an American citizen should not be discriminatory against us because I've decided to get on that VPN and go there, right? If a consumer or investor doesn't want the protection, why are we insisting on it? This is really trying to take the U.S. laws and take it to beyond the world and create it. I think philosophically it doesn't make sense.
Well, if you want an opt-out for laws, I mean, that would be a whole broad change in how we look at things. I mean, I could say, I want to be able to...
Well, there actually is some.
Right, regardless of where you are, you could just put a sign on your face saying, I don't want the protections of the laws, and then I could buy anything. There is no opt-out. As long as you're a U.S. person, you're covered by the laws.
It's about US laws across the world.
It's not
And
extraterritorial
it is,
because
they're
it's just,
promoting
it's more about waiver than extraterritorial. I mean, you could be sitting in the middle of Manhattan or anyone else, as long as you're a U.S. person, you're subject to the law. You're subject to the laws. What you're really saying is that you think there should be an opt-out from the law, which is a fascinating question that we could think about.
There is.
There is. Renounce your citizenship.
If you go and invest in, I can go to Hong Kong and buy something.
Yes.
Physically there. There is already an opt-out.
But as long
Well, this-
as you're a U.S. person,
this-
you could then decide that you didn't like this,
This-
and you
Okay,
can go to
we're running
David
out
and he
of
can
time.
sue.
I think I-
Yeah. By the way, we're gonna have, at 4:30, 5 o'clock, we have a discussions, and all of you guys can be involved. That's what we do, basically, and, you know, you can, you know, discuss, give your opinion. We're gonna videotape it and all this other things. So we like to get you engaged and ask this question. But I want to thank the panel, the guys, very much. This is one of the best panels we've had. We have all of our panelists today. It's very good. But we have some more beautiful program later on. Darrell is going to speak. Ron Davari is going to be speaking about banking and some other regulation. We have a couple of, Alex Mashinsky is going to come here. And so we have until 5 o'clock. We're going to take a break, you know, and then we'll come back. Thank you very much. 1:30, yeah, 1:30, 1:35. It's okay.